Hello, everyone. My name is Mark Cooter. Thank you for joining today's webinar on year-end planning for real estate and construction. My name is Mark Cooter, and I'm a tax partner and leader in our real estate construction practice for Cherry Bekaert. For today's session, this is our third session of 4 webinars that we've had at year-end. Tomorrow is our last, and it is navigating the current political landscape. We thought it would be interesting to share some insights on the political climate after the recent election, as well as some upcoming legislation that might impact the real estate and construction community. We are offering a 1 hour of CPE for today's session for anyone that needs it for their business license. Here's a few items to note before we get started. To receive CPE credit for today, you must answer at least 3 polling questions and attend for the full 50 minutes. CPE certificates will be issued via email within 10 days, and if you've not received them, you can email cbhlearning@cbh.com, and they will be happy to provide after that 10-day period. A recorded version of this webinar will be available in about 1 week and will be sent via email and posted to our website. Our website does contain past webinars and other things that relate to these year-end topics and other real estate and construction topics. So certainly feel free to peruse past webinars. If you have any questions during the webinar, please type them in the Q&A window. And just to note that a short survey will be made available or posted at the conclusion of the webinar, and we'd love to hear from you and get any insights from you about today's webinar, as well as possible future topics you might enjoy hearing about. I'm pleased to introduce our speakers today. Besides myself, we've got Ron Wainwright, who's a partner with Cherry Bekaert in our Tax Credits and Incentives Advisory Group, along with Catherine Baisley, who's a tax partner in our real estate and construction practice. So with that, I'm going to ask Catherine to get us started. Oh, I'm sorry, we've got one sample polling question before we get started. How did you hear about this webinar today? So this is just to allow everyone an opportunity to see how the polling questions are going to work, and let us know how you heard about it today.
There's always such lovely silence while we're waiting for the polling.
While we're waiting on the results. Okay, let's move on. Maddie, there's the results. So most looked like it flashed up there for a second. Most said they'd received an email from the firm about the webinar, or heard about it from maybe they're a current client and heard about it that way or through other means. So appreciate everybody's feedback on that. All right. So what we're going to be talking about today is our top upcoming changes to watch for this year that are impacting real estate. So these are things for our clients that we will be talking to you about at year-end meetings, as well as for those others listening, some top topics that are on the watch list for year-end planning for this year as it relates to taxes and some things coming up. So with that, Catherine, I'm going to turn it over for our first topic.
Okay, good morning, everybody. I'm sure you're all really excited to delve into tax topics. I don't know about the weather where you are, but it's very rainy and gloomy here in Atlanta. So, snuggle up with some coffee or some hot chocolate, and let's dive into the taxes for year end. The first thing we're talking about is changes to bonus depreciation. For those of you that aren't familiar with bonus depreciation, that is an accounting method which allows businesses to write off a percentage of the cost of qualifying assets in the year the property is placed in service. For the past few years, and through 12/31/2022, you can immediately write off 100% of the cost of those assets. Beginning January 1st of 2023, that will drop to 80%. And as you can see, that will continue to drop over the next 4 years. This does not mean that you can't write off 100% of your cost, but you can't write off 100% in the year it's placed in service after this year. You could for example, in year 2023, you can immediately write off 80%, and the remaining 20% will be subject to the depreciable life for the appropriate asset. And why is this important? It's important because a lot of times people wait until fourth quarter to make big asset purchases. So if you're kind of toying between fourth quarter and first quarter of 2023, you really want to take advantage and purchase those assets before year end so you can get the 100% write-off. Another planning technique would be, to the extent that you have control over the placed in service date of an asset. You know, if you're building something and some of those assets may qualify for bonus depreciation, you need that placed in service date prior to year end, so that you can take advantage of this. And this is something that may change in the future, but for right now, this is the legislation that's on, this is the law that's on the books, and it's a very good planning technique.
So Catherine, let me ask you a question. You mentioned the date of service is important. So if I were to buy a building as of 12/31/2022, I don't finish a cost segregation study on it, so I'm having to write it off over a 39-year period. But I do do a cost segregation study, say in 2023 or 2024. Am I going to be subject to those lower percentages, or am I going to be able to write more of that off because of my date in service?
So that is a great question. A cost segregation study, for those not familiar with it, Ron will discuss it a little bit in more detail later in the presentation, but that allows you to move some of the assets from a 39-year life to a lower life recapture period, 5, 7, 15 years. For purposes of bonus depreciation and cost segregation studies, it is all based on when the asset is placed in service. So even if you do a cost segregation study in 2024 and some of the assets are deemed eligible for bonus depreciation, as long as those assets were placed in service by 12/31/2022, you can still take 100% depreciation in 2024, whatever year you're doing the cost seg. And it will be 100% of the remaining, the non-depreciated cost, because you will have taken a little bit over the years. So hopefully that helps folks. Okay, on to our next subject, changes to interest expense limitations. The interest expense limitation is covered under Code Section 163J, and that limits the amount of interest expense that can be deductible in the current tax year. Prior to 2022, we had been able to deduct 50%, and it's changed to 30%. In the next slide, we'll get into a little example, but there is an exception that is available for real property businesses. And what that exception allows is that you do not need to apply the limitation, the interest expense limitation, if you elect into this real property trader business and you depreciate your assets over ADS, which is a longer life depreciation system than makers. And really the biggest takeaway from that is, if you have a building that you would normally depreciate over 39 years, if you are eligible and you will make this election, you now depreciate that over 40 years. If you have a rental property that would have been over 27.5 years under makers and you make this election, it's now depreciated over 30 years. So it's not a huge difference in most cases from a depreciation standpoint, but then you get the benefit of taking your interest expense. And now on this slide, we're just kind of showing you one of the things that has changed. I mentioned the 30%, and that went into effect in 2021. But in 2022, the way that what the 30% is applied to, the adjusted taxable income, is changing. So for years when the 50% was allowed, or 30% for 2021, you would take your taxable income, you would add any interest income that you received that the entity made, and then you could also add back your depreciation and your amortization to come up with your taxable income that would be subject to the 30%. In 2022, you no longer get to add back your depreciation and amortization. And for those of us in the real estate world, those, those are very, very large expenses. So that can make a big difference. So a really simple, very kind of dumbed down example is, let's say you had taxable income of $10 million and your depreciation and amortization expense is $4 million. In 2021, your interest expense would have been limited to 4.2 million, which is the 10 million of taxable income plus the 4 million of depreciation and amortization, or 14 million times 30%. In 2022, you can't add back that depreciation and amortization. So you have your taxable income of 10 million and times 30%. So you're at $3 million. So that there's a big difference there. So whenever possible, you want to make that real estate election, and you need to think about this when you're also trying to figure out what, if you're not making that election, you need to think about what we talked about in the last slide, the bonus depreciation, because that will come into play and impact what you are able to offset for interest expense purposes.
So Catherine, if that, I understand that the interest is going to be deferred, so I can't deduct it currently because I'm subject to that limitation. The
Correct.
interest is deferred to a later period, perhaps when I sell the building, or a later period when I've got more taxable income. Once I make that election is permanent to elect into ADS. Why is this all important to maybe be considering now versus a later time?
Well, for a variety of reasons. Because of the bonus depreciation, if you're going to max that out, you want to make sure that you can take it and that it's not limiting your interest. So you want to think about the real estate election, the bonus depreciation, the interplay between all of those. If you anticipate that you will, if your interest is limited and you anticipate that you will be making income in the future, it may not be as big of a deal. But if you're going to hold on to a building and you don't make that election, then you could have a lot of interest expense that's suspended and it kind of frozen until you're able to sell the building or generate enough income to offset the current year interest expense and any previously suspended interest expense.
So there's a lot of moving pieces, and so the earlier discussion, the better, just
Yes.
to put a plan on this going forward.
Yes.
Okay, thank you.
And it's not a simple answer, of course, because nothing in tax world is. And now we're kicking it off to you, Mark, for state tax deductions.
All right, so state tax deductions. This is relatively new. This came into play starting in 2021, and it's often referred to as the pass-through entity tax election. At this point, as of right now, when we're talking, approximately 39 states and New York City have adopted some sort of PTE tax election law. This is a workaround from when Trump came through and did his tax plan. There was a disallowance on an individual's return. You could only deduct up to $10,000 of personal property taxes and personal income taxes. So there's been a number of workarounds that states have tried to do with this that have previously failed. This is one right now that the IRS has said that they said works and they're okay with, which is why there are more and more states adopting this as the IRS has come out with more guidance, and we're expecting to continue to see guidance from the IRS on this. But right now, about 39 states have adopted this. Unfortunately, each of the 39 states could be different rules. It's important to understand those rules at each state level that you may be filing in as to whether this election applies. But essentially what happens is you make an election on your tax return that allows the entity to pay and remit state taxes on the owner's behalf. And then the entity is able to deduct that state tax payment and lower the taxable income for the entity. This is an overall deduction for the owners and puts them in a better position than if they paid the tax on their individual return, because it allows them a full deduction and it is not limited to the $10,000 per individual basis. is something that you need to look at. So per this slide, is it allows the owners of the pass-through entity an income tax credit or deduction, depending on the state, and it can reduce the owner's state taxable income based on the state rules. You make the state PT election or payments, you would need to make the payments. We would generally recommend you make the payments by year end, so that those can be included on your year-end tax return. This election varies between real estate and construction companies by state. So I will give you an example of that. South Carolina does not allow a pass-through entity election purely based off of rental income. It has to be other types of income to make this election. So that puts the rental income, real piece of real estate, maybe at a disadvantage, whereas construction can make this election and take advantage of it. Maddie, next slide. So the tax election planning, one owner can benefit while another is disadvantaged. So you need to consider this or be in discussion about, is this election right for that entity or for your business? You need to identify any conflicts of interest that may be created by a person that's able to make the election where it disadvantages somebody else. The partnership agreement may need to be amended to allow for this. And the S corporation shareholders distributions need to be monitored, because now the entity is paying state taxes and versus making distributions for taxes from the S corporation. So a lot of pieces once again to consider when making this election. The states are different as to whether the election can be made annually or at one time, and can the election be revoked? That's a different answer by state. Does the election need to be made by a certain date? Does the election apply to all owners? All those are specific and by state. So there's 39 answers to that question, depending on what state you're filing in. And then the election may be most useful for a pass-through entity that generates income, perhaps all in one state. So if you're everything's in Georgia, the property's in Georgia, and all the owners are in Georgia, that may be more beneficial in looking at the election in a much easier decision than if you have owners throughout the country. And also owners that are in states where there's no individual income tax, such as Florida, Texas, and Tennessee, may be able to benefit this. So because there are 39 different answers based on each state, definitely recommend this as a discussion with planning, and our state and local experts can get involved, and we bring them in all the time to consult with timing of these elections, or whether an election should be made and whether it's beneficial to the overall partnership. But definitely something to put on the planning list.
Real quick before we jump into the next one.
Oh yeah, sure. Yeah.
I get questions about the PT election all the time. And it's hard, like you've said, 39 different states with the election, so many different scenarios. Are there any kind of simple, here's a time that you definitely don't need to consider it, or it's probably not too advantageous? Can you, I'm thinking, if your entity makes $1 million and you have 300 partners, that's a very small benefit.
Sure.
For a lot of hassle. Are there any situations?
Sure. Well, you can't make the election when you have partners or shareholders in the pass-through entity that are tax-paying entities themselves. So if you had 300 owners, chances are you've got owners that are more than just individuals. You may have trust, you may have C corporations, you may have IRAs that are owners in that partnership. That would not be advisable to make that election, just because you're going to run into a situation where one owner can benefit while others are disadvantaged, because you could end up in a situation where tax is paid twice, once at the entity level and then again at the owner level. So the type of owners that you have are definitely something you've got to pay attention to, and you've got to pay attention to what states that they may be filing in. So a lot of moving pieces in this, and things that certainly if you've only got $25,000 worth of taxable income, the cost of the election, the timing of that election, that may play a factor. But in general, you need to look at it regardless of the amount of taxable income.
And if you're in a loss, in most
Then you
cases,
would
can you
not,
table it and wait until the next year when you're making
sure.
money?
In most states, you don't have to make the election except annually. And so if you have a loss, you would not want to make this election. You want to let the loss flow through. And then you would also not want to make the election if you've got prior losses that are out there that are suspended, or credits that may be available at the state level. You would want to use those up first before you taking advantage of this election. So a lot of factors.
No simple answers.
Yeah, no simple answer, unfortunately.
Okay.
Catherine, I'll let you take over for the deductibility of losses.
Yes. So we're talking about the deductibility of business losses that are flowing through and net operating loss deductions. So the excess business loss limitation was a result of the Tax Cuts and Jobs Act. It came into play in 2017. There were some suspensions of that under COVID relief, but the crux of this is that income from your businesses that are either pass-through entities on Schedule E, or if you have a Schedule C, the income and the losses will be net together. And in this little example that we have, there's income from some businesses of 500,000, losses from some businesses of 1.25 million, resulting in a net loss of 750. Prior to these limitations being in place, that taxpayer would take a loss of 750 and it would probably generate an NOL. They wouldn't pay any tax. Now that loss of 750 is limited to 270,000 if you are single, or head of household, or 540,000 if you are married and filing jointly. So, if in our example, the 750,000 of net loss, you would only be able to take 540,000 in 2022. That does not mean the remaining 210,000 in our example is lost. It will be carried forward to future years as a net operating loss. So it's very, very important to know it is not lost, but for those that have, maybe participated in cost segs historically to generate very large losses and offset all other income, it's not as easy to do that now. If our taxpayer in this example had $1 million of wages, they can only offset 540,000 of those losses. So they're not eating up all of their income as they've been able to do in the past. Okay, the next slide. Kind of building onto those losses are net operating losses. Net operating losses also changed under the Tax Cuts and Jobs Act, and there was a suspension with some of the treatment under the COVID relief. But for 2021 and subsequent years, net operating losses can only be carried forward. Historically, we've been able to carry them back, generate some refunds. Everybody, we were delivering great news. Everyone loved us, putting cash in people's pockets. Now you're not losing that option of utilizing the losses, but you can only carry them forward. So you may not have as big of a tax impact and cash impact as you would have had in the past. And those losses are limited to 80% of your taxable income for any losses that were generated after 2020. Any losses that you are carrying over prior to 2018, you can still offset 100% of your current year income. So just a very quick, easy example. You have $1 million of NOL that has carried into the current year, and you have $1 million of taxable income. You can only offset 800,000 of that income. So you have 200,000 of taxable income in the current year, and you have 200,000 of loss that will be carried into future years that you can use. And since it was in our example, this was generated this year, that 200,000 of loss that's being carried into future years is limited to 80% of your taxable income. So that does carry. Okay, our second polling question. So anybody that's kind of snoozing at the wheel, pay attention. Will your company be able to make the PTE election in 2022? Absolutely, not a chance, or not sure. Hopefully, I know what answer I would love to see everybody choose. We'll see where people go with this and how much attention everybody was paying. there's a note that says none of the choices are working. It worked for me. I don't know.
Feel free to put your answer in the chat if it's not working for you. And we'll make sure to count you as answering.
Not a chance.
Yeah.
So. Cameron is not sure. Let's chat, Cameron.
All right, continue. You can continue to put those in the chat if you weren't able to answer, but there's our results. As there's some people not sure, and that would tell us obviously that there's going to need to be some discussion around that tax return before the election is made, and to confirm whether A is available and B if it's recommended. So
I think Ron is kicking us off.
All right, thank you, Kat. And thank you all for attending today. So the next two sections I'll be covering is first in regards to really monitoring credits and incentives. And then we're going to talk specifically about some of the energy deductions and the credits and or incentives that occurred within the Inflation Reduction Act of 2022. So I think we all are aware that we really had a surprise agreement in the July timetable, which was reached between Senator Manchin and ultimately Senator Schumer, which ultimately brought forth an act which we refer to as the Inflation Reduction Act of 2022. And I know that all of us understand that there is a significant impact of this act with respect to our real estate, really clients, as well as really anyone within the real estate industry. But just to put a little bit more background on it, because I think it's relevant and very important, is that the Inflation Reduction Act of 2022 was actually the third major piece of tax legislation that was passed. So hopefully everyone is aware of the Infrastructure Investment Jobs Act that was passed in late 2021. Those funds are beginning to roll out now in regards to grants and incentives, as well as potentially credits. We saw the CHIPS Act, which was predominantly geared, but will impact the real estate industry significantly in regards to the CHIPS Act, which was really focused on the manufacturing of semiconductors, a small $250 billion act signed August 9th. And then August 16th, we see the $500 billion plus act of the Inflation Reduction Act. So that just gives you a little bit of background, because in this section, I wanted to cover we have a tendency to use credits, incentives, grants, rebates, deductions, and those are all very defined terms. But let's, from just kind of a perspective, is what is a credit and what is incentive, and what is a discretionary incentive versus what is a statutory credit, because that's very important to understand. So there's really two types of credits, as the slide highlights. So there are discretionary incentives, which is really what was awarded really within the Infrastructure Investment Jobs Act, as well as the CHIPS Act, in regards to the government's discretion to provide incentives to taxpayers. So we saw in all three acts cash grants or refunds. With respect to IRA, we have the new regime in regards to, from the perspective of the direct pay and the transferability credits. You'll see that other discretionary incentives also impact state incentives when we talk about property tax abatements, payroll abatements and training benefits, et cetera. So it's very important to understand when we talk about incentives, those are discretionary either at the federal and or state level. When we move on to credits, because again, these are not interchangeable terms, they're very defined terms, not only in the statute at the federal level, but also at the state level, we're seeing statutory credits. So this is not a quote a discretion, this is as what's referred to as an as of right. So when you think about a state putting in a economic development incentive towards job tax credits or some form of a payroll tax withholding credit, or ITC, which we saw significantly in the CHIPS Act as well as the Inflation Reduction Act. We see training benefits, R&D tax credits, though it's generated by a Congress at the federal level and then the states have adopted. When you think about it, it's really an as of right, which means that there's a fact pattern to that taxpayer where they are able to claim the statutory credit. Now, specifically, the pollution control and recycling credits were significant in the Inflation Reduction Act. And from a real estate perspective, you'll be very focused on those from the standpoint of, those type of credits that are going to be very important in the industry. We also see, rehabilitation credits. Obviously, that's more historic tax credits or an abandoned building type credit in South Carolina. And then we'll talk more specifically towards the energy, as well as what we're seeing from a solar incentive perspective that was contained in the Inflation Reduction Act. So very important to understand there is a difference, a significant difference when we talk about a discretionary incentive as well as a statutory credit. So what does all that mean? Next slide, please. What it means is when we start looking at how we basically assess in a strategic tax analysis, how do we assess the as of right credits or the statutory credits? And then how do we go about assessing what a client and or taxpayer is eligible for when we think about discretionary incentives, i.e. those that are awarded at the government's discretion. And of course, those change annually, if not more than annually at times. And then ultimately we see a third, which is really what we refer to as the site selection services. And that's kind of a hybrid of number 1 and 2. That's again, an economic development tool that states utilize to recruit specific taxpayers, depending on the industry they're involved in. So just some background purposes for you all, you need to be reviewing really all of these now based on the Infrastructure Investment Jobs Act, again, the 21 Act, and then more importantly, the CHIPS, because that impacts as well as last the Inflation Reduction Act. So you need to be reviewing tax returns and work papers and really, identifying those refund opportunities to make sure that you're going to begin to claim those, which will become effective January of 2023. When you think about those discretionary incentives, really you need to be forward thinking here where you're looking at reviewing your capital expenditure budgets, because as Kat mentioned in the cost seg and the bonus depreciation, as well as some of the other areas for tax planning 163J, those are going to be very important to you as you look over the horizon, specifically as the bonus depreciation begins to minimize to 80, 60, 40. And then you also want to begin to look at all the potential state and local incentives that you can stack on to the federal opportunities. And a lot of that is providing some benchmark incentives and benefits. So that as you look over your CapEx, you need to be doing that now from a year in planning, but most importantly, in that 23, 24, 25, and really through 2032, because the Inflation Reduction Act, as we know, is permanent in the statute through 2032. So this is just a high level of what you need to be doing now in regards to year-end planning, and then over the horizon in regards to your CapEx budget, to ensure that when we talk about an incentive and we talk about a credit, either the federal or state government is helping you subsidize that opportunity as you work within your specific fact pattern. So let's go to the next slide and kind of begin to talk about all of the changes to energy incentives. Now, today we'll only have time to really cover 2. So I mentioned to you that we had a little bit of a surprise in July that ultimately came in the form of an Inflation Reduction Act of 2022 that was ultimately signed into law on August 16th by the president. It really was a remnant of what's referred to as the Build Back Better plan, which ultimately failed in the Senate, as we know, because they could not get enough votes. It did pass the House, but you see a lot within the Inflation Reduction Act, specifically when we talk about what is applicable to the real estate industry in 179 Cap D and 45L. Most provisions, as I highlight here, take effect January 1 of 2023. However, as we'll talk further, 45L did get reinstated. Remember that both 179 Cap D and 45L came within the Energy Policy Act of 2005. So it's been out there a significant amount of time. Most real estate clients and or taxpayers have some awareness of these provisions, but the big takeaway here is what happened in the IRA was really a tremendous expansion of the opportunities towards the real estate sector specifically. There are a multitude of clean energy tax credits, deductions, and incentives that are contained. But today we really want to focus on two areas, which is really Section 179D, from the standpoint of the energy efficient commercial building deduction. Again, expansion of eligible buildings. We see that now tax exempt entities may now allocate 179 Cap D deductions to their designers or their A&E firms. That's a significant win on a couple fronts, specifically for tax exempt entities and specifically for those churches, charities, hospitals, private schools, public schools, tribal lands. There's a number of provisions in there. So when we think about 179 Cap D, remember that it was previously made permanent as part of the CARES Act of 2020. The changes that we'll cover today are going to take effect beginning January 1 of 2023 for 179 Cap D. And ultimately, your takeaway, and hopefully you've also listened to some of our other podcasts, is that it increases the maximum available deduction. There is also some new prevailing wage and apprenticeship requirements to ultimately qualify you from the old $1.80 indexed in 22 to $1.88. But now new law tells us that that moves up to $5 a square foot. So there are new modeling standards that we must pay attention to that obviously tie into the prevailing wage and apprenticeship program requirements, but Treasury has not released those requirements. And so today, as we place an asset in service, specifically probably in 2023, we'll be looking at that $5 gross square foot in regards to the energy efficiency deduction. And again, with the new modeling requirements, the old law was 50%. I had to exceed 50% of energy efficiency, and that's now been lowered down to 25%. So again, tremendous expansion here. So
Hey, Ron, can I stop you 1 second just to make sure we make a point on this?
Sure.
So as far as the 179D, you mentioned that the design aspect, that if you design the building, even though you're not putting it into place, you might get the deduction because you've designed it for a church or other not-for-profit that's not able to take advantage or doesn't need the deduction. Could you go into that? It's specifically related to our construction clients that are providing design work, or maybe our architecture engineers or any real estate developers that maybe are doing design work, just so that we're clear on how that might work, on how they take a deduction for something they didn't actually have to spend.
Yeah, sure. So within EPACT, or the Energy Policy Act of 2005, there was a provision in there which, to Mark's comment, construction companies, as well as what was referred to as the designer of the energy efficiency system. That act was specific to say that a governmental entity was allowed to transfer their $1.80 deduction to the, quote, energy efficiency designer of the energy efficiency system. And so A&E firms took significant planning opportunities with respect to this provision. And now, again, it's been expanded to where now a tax exempt entity and other entities, such as an asset on American native land, can transfer that deduction as well to either the construction company and or the designer of the energy efficiency system. Why is this important when you think about a tax exempt organization? Is that they can actually embed within their request for proposals a provision in there that says we recognize we have this opportunity now to transfer this phantom deduction because it doesn't cost anything for the designer of the energy efficiency system to receive the deduction other than the certification. But what we'll see is a shift, if you will, specifically as they've expanded the base of the transfer. So that's where the A&E firms, as well as the candidly, the construction firms will win large, if you will. Kind of going back to 179 Cap D, one thing I want to mention is that when the old statute, or what I call old law, was 0 to 60 cents, most of you are familiar with that, which got you to the $1.80, and then there was some COLA or cost of living there, which got us to $1.88 in 2022. So what we see now is really a deduction which is calculated on a sliding scale. Not only the energy efficiency standards was lowered from 50 to 25%, as I mentioned, but you now are looking at a range of 50 cents to $1 per square foot. And then you have bonus provisions in there, which can get you to the $5. Really, one of the exciting things in regards to our real estate practice is there's what's referred to as a triennial reset of the deduction, as I've highlighted here. So what does that mean? Basically, it means that you now can ultimately receive a 179 cap D deduction more than one time on the asset. So 179 cap D deductions actually calculated and taken for the building now every 3 to 4 years. 3 years in the commercial space, 4 years in the quote tax exempt space. And it really applies to all relevant upgrades to the building made during that time period. So it's again an expansion of the opportunity for a real estate developer to receive, if you own the building, that 179 cap D. So it's no longer what I refer to as a one and done. And as I mentioned, to obtain that $5 per square foot prior to the issuance of the Treasury regulations of what does it mean to have a prevailing wage, and what does it mean to have an apprenticeship program? What are you going to be doing to ensure that you meet that $5 a square foot for any asset placed in service in 2023? You're not underneath those guidelines. The IRS guidance is to come, as I mentioned here, and ultimately what we would expect to happen is those will be released in 2023, and then you'll have 60 days post that regulations to make sure that the prevailing wage and apprenticeship program requirements are met so you can achieve that $5 a square foot. But think about a simple example. When you think about moving from $1.80, I got a 100,000 square foot building. My old deduction was likely somewhere between $60,000 to $188,000 if I met all three standards. Again, the qualifying threshold was 50%. January 1 of 23, I moved 50 down to 25%. And now I'm at that deduction range, potentially at a minimum of 250, i.e. the 50 times the 5 times at 250. And then if I'm at that dollar, I'm up to $5 a square foot. So my deduction moves from 60 to 188,000 all the way up to 250 to $500,000, whether I'm the owner of the building. And then because I'm going to be able to reset every 3 to 4 years, a significant opportunity. And it kind of shows you the focus of building more energy efficient buildings. So let's move on to really kind of one of the next areas. Very important to understand what's referred to as 45L. This candidly is a provision that ultimately got sunset and that was really reinstated within the Inflation Reduction Act. But what do I mean by that? It was reinstated because it really expired at 12/31 of 21. So it was reinstated effective January 1 of 2022 and enhanced, very similar to 179 cap D, the enhancement. So when we think about 45L, this is a credit that is per unit to the extent that that unit meets very energy efficiency standards. And there were some changes from that standpoint. Old law was $2,000 per unit. Now very similar to what I commented in 179 cap D, the maximum available credit to the extent I'm a developer and I'm owner of, let's say, a multi-residential asset, which would be an apartment complex, or it can be a single and residential home as well. If I'm a builder, you can now receive $5,000 per unit. Now, these energy standards are a little bit different, I would point out, because the Department of Energy just November 1st of this year released what was called the DOE standards, or the quote star zero net energy standards, which would be applicable to meet that 5,000 per unit. But again, Treasury has not issued regulations because there's also eligibility in regards to prevailing wage and apprenticeship requirements at the $5,000. So we're in this unique period of time with respect to an asset that could be placed in service in 2023 and or 2022, where we're looking at a $2,000 credit. In 2023, it really resets to a minimum of $2,500 per unit and then goes up to that maximum of $5,000 per unit. But again, we're in that gray area of $5,000 per unit prior to the issuance of those regulations to kind of tell us and tell taxpayers what we need to do to make sure that we meet that threshold. There also was a removal, very important aspect here. There is a removal of a height limitation. So some of you may be aware there was a height limitation of 3 stories to be able to obtain the 45L credit. Interestingly enough, again, it's been expanded to where now I have no height limitation. So we have eligible multifamily developers, specifically in major metropolitan areas, that may be building upwards of 50 floors. All of those units in a townhouse, condominium, et cetera, will be able to qualify. And again, this is really retroactive to January 1 of 2022, and then permanent through all 2032 because of the 10-year limit. So again, I mentioned this briefly. So you have 2 new updates to the energy efficiency standards. Again, DOE just released these, still interpreting them, as well as IRS has asked for comments in regards to the new energy standards. So you really have the 2 new standards. You've got a zero energy ready home certificate, which is needed to maximize the credit. Previously, we were modeling against ResNet, but now we're at a zero energy, often referred to as STAR. And then there is also a partial credit that's available for meeting Energy Star, which is really a national and regional requirement. So that's where, from a planning perspective, you're really going to need to look at, well, where am I from a regional standpoint? And do I also align at a federal or a national level? So think about 45L, a simple example, where I had the old building standard was the IECC of 2006 and 2022. My credit was $2,000. And let's assume I had 50 units, so I earned $100,000 of credit. Come 2023, I'm underneath this new Energy Star, or zero energy ready home, as it's referred to. Minimum credit 2,500, maximum credit 5,000. So now at 50 units, I'm looking upwards of $250,000 of credit. Remember, very different than the energy deduction. That 179 cap D is a deduction that ultimately arrives at taxable income. They're in your tax liability. In this case, it's a dollar for dollar credit from an energy credit perspective. So again, these take effect January 1 of 23. So a lot there. Next slide, please. So again, I don't want to overstress this, but it's very important. You need to begin to plan now, specifically given the Department of Energy issued the November 1st standards, and we can walk you through those if you're interested in regards to planning now for projects that you may or may not have under design, or projects that you're going to begin to place in service in 2023, 24, or 25. Remember, it's all the way through 2032. So that's very important to just begin to look at those new standards, and we can kind of guide you forward in regards to prevailing wage and apprenticeship program requirements based upon our interaction with Treasury and what they are currently considering. They're in a comment period now. And we would expect probably the proposed regs to come out sometime towards the 4th quarter of 2023. Next slide. So remember, as Kat commented and Mark's also commented, we have what we now call, what I refer to as a tax trifecta. What does that mean? It means any building over 3 stories, even if residential, can now qualify for 179 cap D deduction, $5 per square foot. It can qualify for the 45L credit, $5,000 per unit. And then with cost segregation, we can accelerate the depreciation deductions, moving that asset from a 27.5 or 39.5 year life down to a class life below to 20 years, and then take advantage of 168K. So the trifecta, so you get the benefit of all 3. So from a planning perspective, this is a significant expansion and planning opportunity for our real estate clients and developers and construction companies, et cetera. What we've also seen in this 45L, which we often get a question is, well, I'm building the asset now. I know I'm going to qualify, but someone approaches me and they want to buy my asset. So the way 45L works, as an example, is you immediately earn that credit upon the disposition of the asset. 45L would tell us that you earn the credit when you either rent, lease, or sell the unit. In the case where you're selling an entire construction project, because we've seen more and more of this, you earn the credit immediately. So we can go ahead and get that certified for you. So one thing that we are beginning to see, it's very important to pay attention to this, is really the extension through 2024 of what we refer to as solar credit arrays. Remember, there's a 30% ITC credit for solar or qualified fuel cells, waste energy recovery, geothermal, designated electric generation facilities. And so we're seeing a specific movement in regards to solar arrays on the ITC side underneath IRA of 2022. It was reinstated from 26% in 2022 now to 30%. So, and then that phase down begins in the through really the 2025 years when it really begins. So pay attention to this because we see a significant amount of opportunities from real estate developers, because there's also some incentives around battery packs and electrical vehicle chargers that you're going to want to make sure you're taking into consideration as you plan over 23, 4, and 5, based on the subsidies, the credits, the incentives, the deductions, the rebates that you would be eligible for. Next slide. So this brings us to polling question number 3. Based on the information, though at a very high level, how likely are you to take advantage of the energy incentives?
All right, Maddie, let's keep moving just so we can make sure we're finished and maybe have a couple minutes for some questions. Great. So to wrap up, we've got we're going to talk a little bit about some estate and gift tax, and then we're going to have a summary of things people should be looking for year end. Wanted to bring this up just because this was a big issue in 2021 when Biden had come into, and his administration had come in. They were going to lower our current estate exclusion, lifetime exclusion. And that law was looked at the end of 2021. So there was a rush by a lot of people to do some estate planning that ended up not passing and failed. And now we've got a change in Congress. So we think that the law is pretty stable right now with where we are. It's always subject to changes up in Washington. But where we are currently for 2022 is each individual gets a lifetime exclusion of $12,060,000 per person that you can give away during your lifetime without incurring any estate or gift tax. So if you and a spouse, you're married, you have an estate of less than $24 million, there's not really a lot of things you need to do in that situation, assuming that you have planned to pass away in 2022. Obviously, most of us don't know when that event might occur. So we want to bring this up to highlight the issue that as of right now, the current law sunsets at the end of 2025, and the exclusion drops from over $12 million in 2022, 2023, 2024, and 2025. It's going to drop down to about $6.8 million. So it's going to get cut in half in the year 2026. If your estate is large, you have a large estate, or if you plan to make gifts, now is the time to consider making gifts over the course of the next several years before that exclusion drops. The purpose of the gift is to allow you to give away current assets so that future appreciation will be in the hands of the beneficiary or the recipient of that gift, and not continue to make your estate problems worse. The annual gift exclusion for 2022 is $16,000 per donee. So on top of being able to make a $12 million gift, you can make a $16,000 gift annually and not have to file a gift tax return. If you make a larger gift than $16,000 of per individual of cash or non-cash, you may have to consider a gift tax return to report how much of your lifetime exclusion you've used up with that gift. So something to put on your radar to consider discussing with your tax or estate planning counsel. Some common estate planning tools that we're going to see is just review your current and future goals. Consider changes to existing family. Make sure your wills are updated for any issues such as marriages, divorce, or other descendants. Review your current estate plan. Review trust documents. Review beneficiaries of your IRAs. As those change, those will go based on how you filled out paperwork for your beneficiaries, and may not go according to your will. So make sure you're paying attention to beneficiaries you've named on IRAs or other fiduciary accounts. And consider tools like a spousal lifetime access trust, which may allow you to make a large gift to a spouse and still have access to those assets or income from those assets, while your spouse has the principal of those assets. And if you're charitably inclined, consider use of foundations or donor advised funds. These are all tools in a toolbox, and there are many others as it relates to estate planning when you're considering that. Next slide. So in summary, some things you need to pay attention to for 2022 is make sure you're paying attention to the accelerated depreciation rules. This includes the 179 expense as well as the bonus depreciation that Catherine talked about earlier. Along those lines, as far as being able to accelerate those deductions, consider when your asset is going to be placed in service. We are still under the common tax rule of accelerate deductions and defer income. So maybe accelerate, if you can, of when those assets get put into service or when you purchase those. Accelerate charitable donations, which are deductible in the year you're giving them. Consider looking at your defined benefit plan or retirement plans for the company. Can you maximize the benefit or create additions to that plan, such as a VIP or variable interest plan on top of maybe a 401k that gives you ability to contribute more. Make plan contributions timely. Make sure you've fully funded your benefit plans that are in place by 12/31. Sell depressed assets to make sure that you're realizing capital losses or harvesting losses. Look at prepaids and intangible assets and what rules and accounting rules you could use to maybe expense those quicker. Review capitalized costs for repair costs. We include that as part of our cost seg team, where we can kind of look at your recent repairs and maintenance and see, is it stuff that we don't even need to capitalize and perhaps we can expense immediately and not worry about capitalizing it. Make sure you pay accrued compensation or bonuses timely based on when the deductions would allow, and accelerate payment of cash expenses and decelerate revenues. If you've got a contract and maybe you're trying to close on a real estate deal now in December, would it mess up the deal to consider closing in January? That way you put off the tax bill for a whole year versus trying to close it before the end of the year. And you obviously want to pay attention to the intangibles of that, not just let the tax tail wag that dog. Consider using installment sales, which allows you to defer income. And then also make sure you're claiming federal and state tax credits, as we talked about. So that gives you kind of a summary. We've got a last polling question, and then we'll try to get some questions. I know, Ron, there were several questions in there from an energy standpoint that maybe you can tackle first. But will you be taking any action to reduce your tax liability before year end? I would assume that a lot of people will answer that question, but hopefully it's not I like paying taxes, and we probably expect the fewest there. All right, Ron, can you maybe take a look at some of those questions on the energy side, or see if there's some other questions? I know that there were some during your presentation. Ron, you're on mute.
Yep. So Matt, thank you for the question. So Matt's question was, what about buildings less than 3 stories in the tax trifecta? And so, yes, the example was intentional with respect to the expansion underneath the Inflation Reduction Act to 3 stories or more, but it is applicable for really any asset. Remember, 45L was 3 stories or below, when then it said you weren't eligible, obviously, from the 179 cap D perspective. But based on expansion, we're going to want to look at that tax trifecta for 3 stories or below: cost seg, 145L, 179 cap D. Simone, thank you for your question in regards to the solar improvements are made by a non-taxable entity. Can they pass those on to the members? Absolutely. What we also see here is what is referred to as a tax structuring technique around taxable entities, where they'll actually syndicate the credit and raise revenue from that standpoint for the tax entity. The credit ultimately can be utilized against unrelated business taxable income and that liability. So the answer to your question is yes. You can actually pass that on to your members, and or you can syndicate the solar credit. Remember, it was reinstated to a 30% credit. So I think those were the two that I saw in there.
And Ron, thanks for that. We'll try to email back if we see any other questions to the chat. It's the top of the hour. So that concludes our session today. Thank you again for joining us. If you have any questions, please feel free to reach out to any of the presenters today, and we'll make sure to get back to you. We certainly value your feedback and ask you to take part of a short survey at the end, which will appear when you leave this session. And reminder, you'll be emailed CPE certificates, and this presentation will be posted to our website within about 10 days. So we appreciate it. Thank you.